Back in the day when I was looking to make an edge in wagers, I come up with ideas. For example, back then, an NFL team who sucks, and NFL stands for Pro Football, won outright as big underdogs, and usually 7-10, and will now play a road game against a team with a winning record. You play the home team to cover. Now, back then, I could be able to go through several different historical games and see how well that it played out. And what I figured out was, well, if you take a road team who won outright as 7-point underdogs and were on the road again next week, they always lost. And I also found out that those games were also low scoring as well. Oh, I found a lot of different ones like that. In the NHL, ideas back then, if a team plays 2 straight road games, so this is pro hockey, and 3 road games in 4 nights, and has also played at least 9 games in the last 20 days, play the road team on this, play the home team on this final road game. And well, I did the research on that, and it's still actually doing pretty good today. No ideas today, and I don't have enough information to be able to verify this, and I'll tell you why it's almost impossible, even if you take every single stock in the S&P 500. But when a stock or an index loses 60% of its value, then you buy with no stop loss, you ride it out basically, and you sell when you reach gains of 150 to 200%. Now, in theory, you would need a mass capital to do this because the mathematics on this state that if you win, you are going to double to triple, better than double, up to triple the gains on the wager. Therefore, winning 50% of the time, theoretically, would give a lot of profits. And it's very common to see that when stocks get blown out of proportions, that they're going to reverse its change of direction. And obviously, playing long for a gain of 150 to 200% would be better than shorting when a stock gains about 125%, playing for a loss of about 60%. That's harder because historically charts tend to go higher because, well, mainly inflation, I guess. And well, just like in the hockey example, when a team is extremely tired like this, then they're just going to play terrible. And in the football example, when a bad team comes out and they win a game, they're out of touch with reality a little bit. And the other team is going to take them more seriously, and then they generally kick their butts. So now let's take a look at this silver chart. And 60% from 50 would be 20. Again, when I look at historical data, you have to find all the stocks that lost out because you buy Bear Stearns when it loses 60%. You lose. You buy Citigroup when it lost 60%. You still haven't lost yet, but you obviously would be well away from even coming close to cashing out. You're still in the negatives because it lost 60% a long time ago. So sometimes it works and sometimes it doesn't. But generally the theory would be that at what percentage of the time will it be able to triple its value from the point that it loses 60% versus how often it goes to nothing. Now, a commodity just doesn't go to nothing. It's almost impossible for that to be the case within the silver price. Now, the final thing I want to point out is the time. There has been a total of 1, 2, 3, 4 tests of this 26 area. Now, a lot of times people say silver takes the stairwell up and the elevator down, which isn't really also so much true. Escalator up, elevator down, large stairwell up, or maybe escalator up, elevator down, and then this time it took the escalator down and it took the stairs down, the most recent point. Also, what happened after every time it hit 26? It continued to go higher, nothing at a massive level, but enough where it wasn't the stairwell. Like I say, escalator, decent gains, but you're not getting all that in one session like what occurred on the downside. Test number 2 took a huge elevator ride lower, 40 to 26 in a matter of a couple of days. Well, that's quite big. That's about 25%, 30% in just a short period of time. But then it came up to this 33, back down to 28, stabilized with an average of around 31. That's what happened after it hit 26. The second time, like I said before, instead of the elevator ride down, it was the escalator ride down. And the movements after that was decent sized moves. Now, it didn't stabilize in this level quickly. Instead, it stabilized between 28 and 30 rather than 30 and 35 or so, which was the last stabilization, made its move higher. Now it's been stabilizing between 26 and 28, 29. So there's a much larger difference, and it's very difficult to point out what's going to happen if this thing does break below it, because we're at that stage now where it could very easily occur at any time. Now, at this stage here, it could have occurred. It obviously didn't then, but it could have, is what I'm saying. So are we going to take more of a stairwell step down to 20? If it even does go down there, would it be a stairwell step? And that would take us probably into a Halloween or at least Labor Day. Elevator, of course, can happen in a day or two. But I think it's interesting to note what happens on a move down to 20. Because let's just assume that this is 20 and this is 23. If it does something like, say, I don't know, if it just ranges this area, I would be surprised if it even did something like that. Instead of maybe something like here, where it goes down to 20, and then it pops back up to 25 or 26 kind of deal. That would be more to what I'm expecting. As my feeling, or just using logic, and sometimes we're in a world where that just refrains from logic sometimes, so you never know. However, when you got a situation where we're to do something like this and stay between 19 and 22, then that is going to cause a problem within the physical supply versus how many people want it and how many people want to sell it kind of situation. And you can say, well, APMEX just covers their short, they'll get more. Okay, well, how much longer can they get more? And how much can they get more? Which is an interesting situation as well. Also, any move down to below this area, it's most likely that the stock market may go down to 11,000, 10,400, or even who knows how much lower. And we'll be hearing all of this QE3 talk. And that just might be what really triggers this thing. You hit a QE talk, silver's at 21, boom, oh, it's at 24 at the end of the day. That's a gain of about 15% in one day. Okay. And then the next day it's up to 26. So that's that big spark move that I was talking about that could hit it quickly from like 20 to 26 and then do something similar like it did in 2009, because in 2009 it sparked from the $8 level up to really about the 12-ish so fairly quickly, and then it just worked its way higher from there. So that will be the end of that. Again, I would guess that if you were to play this strategy with every stock, say on the S&P 500 going back to 1970, that it would be doing fairly well, to say the least. And if you look back at some historic stocks, say you see a stock fall from, say, 20, well, now you'd be buying at 8, and you'd be selling it at pretty much between 20 and 24. And that's the idea upon the game, if you will, because that's all this is that of a game. Thank you for tuning in.